Good afternoon. Today is Tuesday, January 24th. Welcome to a briefing with the Ways and Means Committee. We will have a briefing today on Maryland's revenue structure by our very own George Butler. Woo! And Charity Scott. Give her a warm welcome. Thank you very much. So whenever you are ready, Mr. Butler, I will let you take it over. And committee, we will hold questions until the end, or whomever's starting.
Good morning, Madam Chair, members of the committee. For the record, my name is George Butler. I'm a policy analyst with the Department of Legislative Services. As the Chair indicated, I'm joined today by my colleague, Charity Scott. I'd also like to take a moment before we begin to recognize the contributions of additional colleagues, Harry Hall, Tatiana Hill, and Ryan Holland to today's presentation. They will be providing an overview of Maryland's revenue structure. Maryland imposes a variety of individual and business taxes to fund programs and services in this state. These taxes include the individual income tax, corporate income and other business taxes, the sales and use tax, state property taxes, transportation taxes, inheritance and estate taxes, and several excise taxes. State tax revenues are estimated at approximately $27.6 billion in fiscal 2023. While over 83% of state tax revenues go to the general fund, some state tax revenues are dedicated to special funds to pay for specific programs, as is the case with transportation taxes or portions of the corporate income tax. State law authorizes local jurisdictions to impose various taxes, including property and income taxes. Maryland's mix of taxes is diverse, but weighted towards the individual income tax. The individual income tax rates are relatively progressive, but the tax base is fairly narrow due to exemptions, deductions, and credits. The sales tax rate is not generally high, but the tax base is also relatively narrow. The corporate income tax rate is higher than average, but Maryland does not have combined reporting, and numerous tax incentives are available to businesses. Lastly, local income taxes are a significant revenue source for local governments. This slide notes the state's major tax revenue sources. Charity will now provide an overview of the individual and corporate income taxes.
Good morning, Chair Atterbury, Vice Chair Washington, and members of the Ways and Means Committee. So beginning on page 5 of your handouts, Maryland residents and non-residents who earn or receive income from Maryland sources must pay the state income tax. In 2020, around 3.2 million returns were filed in Maryland, 2.5 million of which, or about 78% of all returns, had net taxable income, which means taxes were owed to the state. The income tax is imposed at various rates based on income and filing status. Members of pass-through business entities, such as sole proprietorships, partnerships, and LLCs, generally are taxed at their individual rates rather than as entities under the corporate income tax. Page 6 walks you through how your individual income tax is calculated, starting with your federal adjusted gross income, which is brought over from your federal return. Then you would either add to or subtract from that amount by applying Maryland addition or subtraction modifications to arrive at your Maryland adjusted gross income. Then you would subtract any itemized or standard deductions and any exemptions to determine your Maryland taxable income. This is the amount that is used to determine what tax bracket you fall into. And finally, to calculate tax liability, that's how much, if any, tax is owed to the state. You would multiply your Maryland taxable income by the applicable state tax rate, and then reduce that amount by any credits that you can claim. Note on this slide that deductions, or as they're known for state income tax purposes, subtraction modifications, reduce your taxable income, which in turn could put you in a more favorable tax bracket. And tax credits reduce, dollar for dollar, any tax liability you might have. And then finally, local income taxes are calculated by simply multiplying your Maryland taxable income by the local income tax rate in your county. Slide number 7 shows the income tax rate schedule. In Maryland, as you can see, the rates start at 2%, progressively increasing as income increases to the top rate of 5.75% for taxable income in excess of $250,000 for individual filers or $300,000 for joint filers. The majority of returns filed in Maryland fell into the 4 3/4% tax bracket. Turning to the next slide, page 8 in your handouts, taxpayers can reduce their taxable income by taking the state standard deduction or by itemizing their deductions. And what you do on your federal return dictates what you do on your state return. In 2016, 55% of all taxpayers took the standard deduction. That percentage has increased to 79% in 2020 and 2021 since the federal government doubled the federal standard deduction amount in the 2017 Tax Cuts and Jobs Act. Most taxpayers may also reduce their taxable income by claiming the state personal exemption, the amount depending on income and filing status. Personal exemptions can also be claimed for certain dependents. If you turn to the next page in your packet, page number 9, you'll see how the state personal exemption amount is determined. Two things to note here are that personal exemption amounts range from $800 to $3,200 depending on the taxpayer's federal adjusted gross income, and that the exemption phases out entirely for single taxpayers with federal adjusted gross income higher than $150,000 and $200,000 for joint filers, which means those taxpayers cannot claim the personal exemption. On pages 10 through 17 in your handouts, we will walk through how the state individual income tax has evolved to what it looks like today, from when it was first enacted in 1937 at a flat rate of 0.5%. A year later, when it was scheduled to expire, it instead was replaced by a 2.5% tax on ordinary income. And for about the next 30 years, the most significant change was a tax rate increase from 2.5% to 3%. In 1967, graduated rates were first introduced, and this was also the year that the local income tax was authorized, and the year in which the state income tax surpassed property taxes to become the largest single source of state tax revenue. And then you will see that over the next 45 years or so, tax rates, deductions, and exemption amounts fluctuated depending on the fiscal condition of the state at the time and federal tax changes. 16. One back. The top individual income tax rate of 5 3/4 was enacted in 2012, which is where it sits today. And in 2018, the General Assembly passed legislation increasing the state standard deduction and indexing it for inflation. That bill also expanded eligibility for the earned income credit, which I'll get into later in this discussion. So on page 17 of your handouts, the most recent changes to the individual income tax of note are highlighted here. In 2020, pass-through entities were authorized to elect to be taxed at the entity level or like a corporation, enabling its members to claim a tax credit against state and local taxes on their individual returns. This change was in response to the federal Tax Cuts and Jobs Act, which capped the state and local tax deduction at $10,000 under the individual income tax. Finally, in 2021, and in response to the financial impact of the coronavirus pandemic, legislation was passed that exempted from taxes for tax years 2020 and 21 various income in order to provide some relief to those individuals. And earned income credit benefits and eligibility were expanded further as well. On pages 18 and 19 in your handouts, these slides highlight the significant changes to the local income tax since it was enacted in 1967. Note on page 18 that the local income tax is a mandatory tax, meaning counties may not opt out. The tax was intended to reduce pressure on property taxes, provide additional education funding, and to end local earnings taxes based on where a taxpayer worked as opposed to where they lived. Initially, it was calculated as a percentage of the state income tax, but in 1999, it was changed to a flat rate. And finally, note on page 19 that in the 2021 session, counties were authorized to impose local income taxes on a bracket basis. Currently, counties may impose tax rates between 2.25% and 3.2%. For tax year 2022, only Worcester County imposes the minimum of 2.25%, while there are 11 counties that impose the maximum. On page 20, just note here that the individual income tax is estimated for fiscal year 23 to bring in around $14.1 billion in state revenue, or almost 57% of all general funds. And the local income tax in that same fiscal year is estimated around $8.6 billion. Turning to the next page in your handouts, page 21, you're given a sampling of individual income tax credits, which again directly reduce the amount of tax you owe. These credits include a poverty level or low income tax credit, which is equal to a percentage of earned income. Also listed is the credit for donating a perpetual conservation easement for land preservation purposes. Parents and caregivers may be able to claim a credit for child independent care expenses, and taxpayers may be eligible for a one-time credit for premiums paid for long-term care insurance. And finally, the student loan debt relief tax credit authorizes a fully refundable credit of up to $5,000 for qualified students who have incurred at least $200,000 in student loan debt and have at least $5,000 of that outstanding.
I just want to interrupt you for 1 second. Members, the document was too large to be uploaded, so it all was just emailed to everyone at your inboxes. So Sarah was getting a lot of questions, so have your staff send it to you. Thanks. I'm sorry. Sorry about that.
Okay, on slide 23, we've highlighted here significant individual income tax credits and deductions. And then you'll see on pages 24 through 33 of your handouts, when you eventually get them, we will go into these credits and deductions in more detail. Starting with the deduction for home mortgage interest, taxpayers who itemize, meaning they don't take the standard deduction, can deduct home mortgage interest amounts paid during the taxable year. This deduction flows through from the federal return. Note that the 2017 Tax Cuts and Jobs Act limited this deduction to interest on principal amounts up to $750,000. This limit, however, applies only to mortgages secured after December 14th, 2017. Note that around 567,000 taxpayers claimed this deduction in 2018, and it was estimated to reduce state tax revenue by $403 million in fiscal 2020. Here you'll see that Social Security benefits are exempt from state taxes. This exemption was claimed on approximately 395,000 returns in 2018 and estimated to reduce state revenue by $334.5 million in fiscal 2020. So over the next 2 slides, we'll deal with the pension exclusion. So if you're 65 or older or totally disabled, Maryland law allows you to exclude from your taxable income a certain amount of your pension income. The amount excluded is capped at the maximum annual Social Security benefit amount, which in 2022 is $34,300, and that amount is further reduced by the amount of any Social Security payments received. The Social Security offset, as it's commonly referred. But for those who are retired military, law enforcement, correctional officers, fire and rescue and EMS personnel, or forest, park, and wildlife rangers, they may exclude the first $15,000 of their pension income beginning at age 55, which gives them an early start. On the second page, page 27, note that retirement income from IRAs, Roth IRAs, Keogh plans, and simplified employee pension plans do not qualify for the pension exclusion, under current law. In 2018, this exclusion was claimed on 299,000 tax returns and estimated to reduce state revenue by $255.5 million in 2020. So on the next few pages on the slides, focus on the Earned Income Credit, which was enacted in 1987 as a non-refundable credit in an amount up to 15% of the federal Earned Income Tax Credit. This credit supplements the federal credit and is designed to help the working poor. Eligibility is tied directly to the federal credit, with one exception being when the General Assembly passed legislation in 2018 allowing individuals without children to claim the credit beginning at age 18 instead of age 25 as required under federal law. The state Earned Income Credit was made refundable in 1997. In 2019, the refundable portion of the credit was limited to 28% of the federal credit. However, under the 2020 Relief Act passed by this body in response to the coronavirus pandemic, that percentage was increased to 45% for tax years 2020 through 2022. And for individuals with no children, the percentage was increased to 100% but capped at $530. Both of these changes are scheduled to revert back to 28% for the current tax year. Given this expansion, if you refer back to the chart on page 28, you'll see its impact by comparing tax years 2019, which was before the expansion, and 2020, which was after. Note here that both the number of low-income workers claiming the credit and the overall amount increased as a result of the expansion. Moving on to page 31, slide 31, taxpayers who itemize can deduct charitable deductions made to qualified organizations, like the home mortgage interest deduction. The charitable deduction flows through for state tax purposes from the federal return. In 2018, this deduction was claimed on approximately 655,000 returns and was estimated to reduce state revenues by $272.3 million in fiscal 2020. Taxpayers who itemize can also deduct real estate or property taxes paid during the taxable year. The 2017 Tax Cuts and Jobs Act limited to $10,000 the amount of state and local taxes, which includes real estate taxes, that can be claimed as itemized deductions. That cap, known as the SALT cap, is scheduled to expire in 2025. In 2018, the real estate tax deduction was claimed on about 654,000 returns, estimated to reduce state revenue by $219.6 million in fiscal 2020. And finally, the senior tax credit, which passed just this last session, allows residents who are at least 65 years old to claim a non-refundable credit of $1,000 or $1,750 for joint filers if the resident's federal adjusted gross income does not exceed $100,000 for single filers or $150,000 for joint filers. The credit is estimated to be claimed by about 310,000 Marylanders and to reduce state revenue by $291 million in fiscal year 2023. The chart here shows how Maryland's top individual income tax rate compares with that in the surrounding states. You'll see that it's tied with Virginia for the second lowest rate. So now we're going to move on to the corporate income tax. And we're talking about C corporations here, not entities like LLCs or small businesses. Those are generally pass-through entities that are taxed under the individual income tax. So the starting point for calculating the corporate income tax is federal taxable income, which is carried over from the entity's federal return. And after Maryland's subtraction and addition modifications are applied, that gets you to the corporation's Maryland modified income. At this point, if the corporation is entirely an in-state corporation, its Maryland modified income is its taxable income, and that amount is simply multiplied by the current corporate income tax rate of 8.25% to determine the corporation's tax liability, minus any credits. But if the corporation is a multi-state corporation, that corporation's taxable income is calculated using a single sales factor apportionment formula, which is used to determine what portion of the corporation's total income is attributable to Maryland based on the amount of business carried out in Maryland. And then here you have a quick history of the Maryland corporate income tax. There haven't been a lot of changes over the years other than growth in the rate. You can see here that it started out in 1937 at a relatively low 0.5%, grew to 7% over the next 30 years, and the last increase to 8.25% took effect in 2008. So here we have highlighted some of the more significant corporate income tax changes that have occurred over the years. One being the switch to a single sales factor apportionment formula for multi-state corporations. Before then, the formula took into account three factors, the corporation's property, sales, and payroll in Maryland, and calculated how much of the corporation's income was taxable based on an equation that weighted those three factors. But in 2018, the General Assembly put into place legislation that phased in for 2022 the single sales factor apportionment formula, which will take into account only the income from sales in the state. This formula is mandatory for most corporations, with one exception for certain worldwide headquartered companies, and which may continue to use the three-factor formula if they so choose. Some other issues that have come up over the years were a couple of mechanisms seen as tax avoidance loopholes, Delaware holding companies or captive real estate investment trusts, and both of those loopholes were closed in 2007. Then finally, you see a sampling here of the many tax credit programs that corporations may avail themselves of in order to reduce their taxable income. Many of them you may already be familiar with. If you have any questions about any of these programs, I'm happy to speak with you offline about them. Many of these programs are administered by the Department of Commerce, which reports annually on their progress and impact. This slide lays out the impact of the corporate income tax on state revenue. Approximately 60,000 corporate income tax returns have been filed annually in recent years, with about 55% of those filed by in-state corporations. Corporate income tax revenue is distributed between the general fund, the transportation trust fund, and the higher education investment fund, and you can see the breakdown of the estimated 2023 revenue, which is in total around $1.86 billion that goes to those funds. And finally, local governments are not authorized to impose a corporate income tax. And then here you can see Maryland's corporate income tax rate of 8.25%, how that compares to that of our neighboring states. Only West Virginia and Virginia have a lower rate. But I should note that these rates are for 2022. Recent legislation passed in Pennsylvania drops that state's rate to 8.99% in 2023 and will gradually decrease to 4.99% by 2031. And with that, unless there are questions, I think I will turn it over to my colleague, George Butler, to discuss the remainder of our presentation.
So we'll next turn to the sales and use tax. The state imposes a 6% tax on sales and use of tangible property and certain digital products in the state, as well as some selected services, which we'll speak to in just a moment. Medicines, food, and most services are not taxed. Alcoholic beverages are taxed at a special rate of 9%, and certain passenger car and truck rentals are taxed at a rate of either 8% or 11.5%. The next 4 slides provide a history of the sales and use tax since its inception. Since it was first established, the rate has risen from 2% to its current rate of 6%. You'll also see that numerous exemptions have been implemented over this period of time as well. So, pardon me. This slide notes significant changes from most recent years. Of note, during the previous legislative term, the sales and use tax was applied to remote and online sales in the wake of the South Dakota v. Wayfair case. That decision was rendered in 2018. And then we also recently expanded the sales and use tax to also apply to certain digital products and codes. This slide notes significant exemptions and their associated revenue costs for fiscal 2020. Food for home consumption was foregone revenues of $737.6 million. For medicines and medical supplies, $550.8 million. For sales to governmental entities, $508 million. For exemptions related to residential utilities, $415.9 million. For certain agricultural products, $245.5 million. And lastly, personal property used in certain production activities, $114.7 million. Maryland currently taxes a limited number of services under the sales and use tax. A handful of states tax a significant number of services under their sales and use taxes or through excise taxes. Those states include Hawaii, New Mexico, North Dakota, and South Dakota. Delaware and Washington State also tax a large number of services through the imposition of business gross receipts tax. Projected fiscal 2023 sales and use tax revenues total $6.2 billion, or approximately 26% of all general fund revenues. We would note that local governments are not authorized to impose general sales taxes, but they may impose, or certain local governments may impose select sales taxes, such as on utilities, hotel rentals, and parking taxes. Slide 51 provides a comparison of this state to its surrounding states for tax year 2022. You'll note that Pennsylvania, Virginia, and West Virginia authorize local sales taxes to be imposed. And previously, only Virginia did not exempt food purchases from sales and use taxes. However, that state now does provide such an exemption. So next we'll turn to property taxes. The state property tax dates back to the 18th century. State property tax revenues are special fund revenues that are dedicated entirely to pay the debt service on state GO bonds. Historically, property tax was a local tax that provided the largest source of revenue for local governments. However, there's been a dramatic decline in the importance of the property tax for state revenue during the 20th century. And there's also been a corresponding decline in the importance of property taxes for local revenues with the establishment of local income taxes and increased state aid. The state real property tax rate is currently set at 11.2 cents per $100 of assessed values, as set by the Board of Public Works. The state does not impose a tax on personal property. In the early 20th century, the property tax constituted almost 50% of total state tax receipts. However, by 1940, those revenues were only 13% of total state tax receipts. And in fiscal 2023, the property tax will provide only about 4% of total state tax receipts, or $927.2 million. The next three slides provide the history of the property tax since 1975. Of note, in the 1970s, we saw the enactment of both the homeowner's credit as well as the homestead credit. And you'll see on slide 56, previously in 1979 we moved to the triennial assessments. And then in 2000, the assessment method for property taxes changed from a method of full value assessment. Previously, real property taxes applied to 40% of the value of the rate. They applied to 40% of the value of the property and at a rate of 21 cents per $100 of assessed value. However, when we moved to the full value assessment, the state tax rate changed to 8.4 cents per $100 of assessment in response. And you'll note on this slide that the current rate of 11.2 cents per $100 of assessed value was adopted in 2006. You can see that over the years, general funds have been used to supplement these revenues, and this year there's a $433.8 million in general funds used to supplement debt service in the fiscal 2024 budget. Turning next to local property taxes, state law authorizes all counties and municipal corporations to impose taxes on both real and personal property. For the 2022 to 23 taxable year, county real property taxes range from $0.682 to $2.248 per $100 of assessed value, and municipal real property tax rates range from 0 to $1.44 per $100 of assessed value. Under state law, county personal property tax rates are imposed at up to 2.5 times the real property tax rate. 6 counties exempt all personal property from taxation, those being Caroline, Dorchester, Frederick, Kent, Queen Anne's, and Talbot counties. Garrett County does not impose personal property taxes on business personal property, but it does tax the personal property of non-utility generators that's used to generate electricity. Fiscal 21 local property tax revenues totaled $9.8 billion. We turn next to transportation taxes. There are 2 main types of transportation taxes: motor fuel tax and vehicle excise tax. Motor fuel taxes were first enacted in 1922 via an excise tax imposed on each gallon of motor fuel sold in the state. The most recent significant changes to the tax were made in 1992 and in 2013. The excise tax is annually indexed to inflation, and a sales tax equivalent rate of 5% is also imposed on the sale of motor fuel. The combined applicable rate for gasoline is 42.7 cents as of July 1, 2022, and projected total fiscal 23 revenues total approximately $1.34 billion. Those are dedicated to funding state and local transportation projects. The vehicle excise tax was enacted in 1933. It's a titling tax that's imposed on the fair market value or the purchase price of a vehicle with a trade-in deduction allowed. The last significant change to the titling tax was in 2007 and took effect in 2008, when the tax rate was increased from 5% to 6% and a trade-in deduction was authorized. Projected fiscal 23 revenues from the vehicle excise tax total $1.03 billion, and once again, those are also dedicated to funding state and local transportation projects. We now turn to other sources of state tax revenues, namely tobacco taxes, insurance premium tax, estate and inheritance taxes, transfer and recordation taxes, public service company franchise tax, alcoholic beverage taxes, and the digital advertising gross revenues tax. With respect to tobacco taxes, a $3.75 tax is imposed on each pack of 20 cigarettes, and a 17.5-cent tax is imposed on each cigarette for packs in excess of 20 cigarettes. In addition, a 15% to 70% tax is imposed on other tobacco products. Those are, by example, cigars or smokeless tobacco. Projected fiscal 23 revenues total $463.8 million. Companies that sell insurance at risk that are located in this state are required to pay a 2% tax on their premiums. Projected fiscal 23 revenues for the general fund total $648 million. For the estate tax, an estate tax return is required for every estate that has a federal adjusted gross estate equal to or exceeding $5 million. If the decedent at the date of death owned real or tangible personal property having a taxable situs in this state. The maximum tax rate that may be imposed is 16%. The threshold for the federal estate tax in calendar 23 is $12.92 million. That amount is indexed to inflation. Consequently, there are instances where an estate has Maryland tax liability but may not have federal tax liability. Projected fiscal 23 revenues total $198.1 million. A 10% inheritance tax is applicable to the transfer of property from a decedent to a beneficiary other than a lineal heir, sibling, or a domestic partner. For fiscal 23, those revenues are projected to total $70.6 million. Transfer and recordation taxes may also be imposed on certain property transactions. Those tax revenues are projected to total $258.5 million in fiscal 23. We'd also note that most local jurisdictions also impose transfer or recordation taxes. Companies that are engaged in telephone business in Maryland or in the delivery, transmission, or distribution of electricity or natural gas in the state must pay a franchise tax of 2%. Those tax revenues are estimated to total $142.9 million for fiscal 23. Taxes are imposed on the sale of alcoholic beverages, including distilled spirits, beer, and wine. The tax rates are $1.50 per gallon for distilled spirits, 40 cents per gallon for wine, and 9 cents per gallon for beer. Those revenues are projected to total $35.9 million in fiscal 23. And lastly, with the digital advertising gross revenues tax, persons with global annual gross revenues greater than or equal to $100 million must pay a tax on revenues derived from digital advertising services in the state. The tax rates range from 2.5% to 10%, depending on the amount of global annual gross revenues. However, challenges to this tax have been filed in both federal and state court, and litigation is ongoing. And lastly, slide 72 notes additional significant sources of state revenues. In fiscal 23, federal funds of approximately $18.6 billion are anticipated. It's approximately 30% of all state revenues. Higher education, tuition fees, and other revenues total $4.8 billion. Those are all special funds. That's about 7.9% of total revenues. Fees and revenues collected by various departments and state agencies at $4.5 billion, or about 7.4%. And lastly, state lottery and casino gaming, which is expected to generate $622 million for the general fund and $990 million, or just over $990 million in special funds. And with that, Madam Chair, we'd be happy to answer any questions by the members.
Thank you. That was incredibly informative, and I would urge all the members to hold on to this for the next 4 years. We will not have this briefing every year. This is the beginning of a new term. We have new faces, so this is your 101. And we do have some questions, so I'll begin with the Vice Chair.
Thank you, Madam Chair. Thank you, Madam Chair, and George and Charity, thank you so much for your hard work, and along with you two and Stan have been just amazing people to work with when it comes to taxes here in Ways and Means. So thank you for all your hard work. I do have some quick questions that you could probably answer really fast, and then I have one big one on alcohol tax. The student loan tax credit is up to $5,000. Is that a one-time tax credit? Or is it annual that students are able to get that? Or how does that work?
So it's up to $5,000, though we would note that generally the Commission has certified credits at a lower amount, and the credit may be claimed multiple times.
Oh, wow. Okay, thank you. I'll be sure to send out an email about that soon. The other question was about, Charity, I think you had a list of about 12 different tax credits for businesses. Mm-hmm. And there's 12 different tax credits for businesses. Can you compare those for individuals in the state? Like how many tax credits we have available for individuals? Do we know that answer to that? No.
I have a list I can get to you.
Fair enough.
I don't know the numbers off the top of my head. The individuals, of course, there are more.
Mm-hmm.
Okay, perfect. Okay, cool. Just wanted to compare those two. My last question, Madam Chair, is about the alcoholic beverage tax credits. I noticed in South Carolina, in Maryland, we don't have a local tax credit, local tax on alcohol, on the sale of alcohol beverages. There's only the statewide tax, and it goes to the state. In a place like Montgomery County, where they own their own liquor stores and are able to gather revenue or income from the sale of alcohol, but not necessarily from the tax, some of us, like Prince George's County, don't get that tax directly, right? Or that revenue that Montgomery County receives. And this isn't me picking on Montgomery County, but states like South Carolina, they do have a local tax on alcohol, on the sale of beverages that they're able to do, and even hospitality. I wonder why we don't have that in the state of Maryland. Is that just because we haven't done it yet? Is that something that's just not available to us for localities to be able to impose a different tax on it if they wanted to? Because in Prince George's County, we have a multitude of liquor stores, and we sell a lot of alcohol, but we don't receive the revenue directly from those. That revenue goes directly to the state of Maryland. And I wonder what's the feasibility of having counties to be able to have their own local tax on alcohol.
It would be you need to expressly authorize that, and that's just a policy decision that the General Assembly has made to date. That's not to say that it couldn't change, but
Got it.
that's just how you've proceeded so far.
Fair enough. Thank you.
Delegate Buckle and then Delegate Hornberger.
Thank you. I just had two kind of quick questions. Charity, when you talked about the single sales factor, it's great to see you back, by the way. Charity was a fantastic analyst for the committee for years. Yes, it was good, wonderful to see Charity back. Yes. I've had like flashbacks of the single sales factor debate from years ago and how complicated it was. If I recall correctly, there were a couple of industries that really were concerned about changing the taxation formula. I think retail, energy, certain energy utility providers. Sure, there were a couple of others. Are you aware, I'm not putting you on the spot of like personally of how it's all worked out, but are you aware of any analysis that either DLS or the Comptroller's office may have done to say, hey, now that we've enacted this for a couple of years, what type of an impact has it had? Has it increased the taxes for these companies? Has it had a anti-competitive effect, or was it all just sort of sound and fury signifying nothing and it's all kind of worked out to the same? Is there any analysis of that?
Not that we're aware of. I think the only exception right now to the single sales factor requirement is worldwide headquartered companies.
Right, we did that for a couple of the major corporations that sort of threatened is not a right word, such an ugly word, but they sort of indicated, if you do this, we may not be Maryland companies too much longer. I just am interested in that from the standpoint, we pass a lot of tax policy, and then I think it's important to go back 3 to 5 years later and take a look at what the real world impacts were, because, we'll forget about them. We'll move on to the next issues, and it's important to get that analysis. My second and final question for George, I think this is right. One of your slides talked about the state property tax rate, the percentage that goes to the state as opposed to the localities was set at 11.2 cents in
2008 or so.
quite a while ago per $100 of assessed value. Is that still that's still the rate?
Yes, it is.
Okay, so then anything above that that's going to people, that's just the adjustments in the county portion of the property tax rate. We're still getting our 11.2 cut. Thank you.
Thank you, Madam Chair. Thank you for the presentation, very informative. We also had a presentation not too long ago from SDAT, and I wanted to, this is always a source of confusion in dealing with our county governments and municipal governments. There's the obvious tax income at the property and income tax that counties, for example, can collect, right? We all know about those. And then we got a briefing from SDAT that there's actually some discretion with the homestead tax credit caps, and counties can go from 0 to 10%. What I'd like to see, or if there is a list of all of the discretionary county and municipal tax rates that can be either piggybacked, assessed on their own standing, that are purely at the decision level of the county and or municipality. And then also over the years, this committee has passed what I'll call optional tax breaks that counties can implement. So 100% service disabled, special employment opportunities. I don't know if there's a centralized document or a place where we can reference to all those to be able to say, hey, county government, here's everything you can do that we've authorized so far. Because I don't know about my colleagues, but we're constantly getting asked, can we cut this tax? Can you cut that tax? I want to do a special thing. And a lot of those have already been passed, but I just don't have a definitive list. So I would just, maybe we could add that to the presentation, or if the committee could be made aware of all of these, that would be tremendously helpful. Thank you.
We'd be happy to get you that information.
Thank you.
So that was a question, and we love the ponytail.
I'm not sure about the we part.
Delegate Eversole.
Can't follow that very well. I don't have a ponytail. I'm working on it, though. On slide 69, you have some stuff about alcoholic beverage taxes. And first of all, at the bottom, it says 35.9 million revenues. Does that include both of the taxes above that on the page?
Yes, that's the combined, and once again, we will point at, these are the excise taxes, and then you also have separate sales
So the
taxes.
35.9 is just for the excise taxes?
Correct.
Are we having any trouble defining $1.50 per gallon for distilled spirits and then significantly lower for wine and for beer? Yeah, cocktails in a can are still taxed at the distilled rate, even though they're not pure distilled liquor in that case, right?
Correct.
Okay, that's all I wanted to know. Thank you.
Delegate Hartman.
Thank you, Madam Chair, and thank you to the panel. Just want to comment that the Delegate Hornberger's questions were interesting. He must have special connections to the county executive or something that, you know, made those questions so important. But anyway, question about the fuel tax. I always thought it was just the increase, the flat rate with the increase from CPI. So it's 5% of the average of the prior year plus the 42.7 cents?
No. You have two different factors. There's the wholesale per gallon tax, which is now adjusted for inflation, and then you have a sales tax component as well, 5% sales tax component. The combined rate of both the per gallon as well as the percentage tax, that is 42.7 cents, I believe.
Okay, so as of July is when they calculate the last
Correct.
year average.
Yeah.
So the total this year was 42.7. Thank you. And then a question on the interest on the primary on loans up to 750,000. So hypothetically, somebody have $1 million mortgage, they can only deduct interest on 3/4 of that.
Correct.
Are they still entitled to a deduction for a second home? Or does
Yes.
that 750 consume,
They're still entitled to the second home. They
And
just-
that has
they're-
a
They have to
seven-
stay within that 750,000.
that has a limit as well? Okay, thank you. And you said the enterprise zone, you want to talk offline?
Oh,
I mean,
I can
we talk
answer
about that a
questions.
lot,
Yeah.
but if I see a piece of property advertised that's in an enterprise zone, what benefit does that have to somebody that would be possibly purchasing that property?
There are property tax credits available under the enterprise zone program.
Is it always a standard, or does it depend on?
Standard.
Yeah.
So what,
It's a standard credit, and then the state and the county effectively split the cost of the credit program.
so what is that?
I don't recall offhand the rate. I believe that it's effectively it's a rate and phases down over a period of years related to the property. I can
We can follow up
pull
with
that
you.
piece of
You
legislation.
could follow up, like what qualifications, do
Sure.
you have to spend a certain amount, you know, is there a certain amount of investment? All those kind of things, what makes that attractive to somebody?
Okay.
Thank you.
Delegate Wu.
Okay, thank you for the presentation. I think there are a lot of stuff to remember. And I have one question about the tax rate, corporate tax rate. Right? So you compared the neighboring states between Virginia, DC, and Maryland, other states. I've been hearing a lot about try to increase competitiveness of Maryland to do business, right? To attract more business and jobs to Maryland. So do we have any study like how to do that in terms of tax structure or tax rate, anything like that from your department?
The Augustine Commission, back in, I'd like to say 2015 or 16, examined tax policy of the state. They had different recommendations. I'd be happy to provide you a copy of their report.
I would really appreciate that. Thank you.
Okay, are there any more questions from the committee? Okay, seeing none, thank you both very much for your presentation. And committee, we are adjourned until 1 p.m. sharp when we have bill hearings. Thank you.
Thank you, Madam Chair.
I believe I can't remember enterprise zone credit amounts.
It phases down over
Yeah,
like,
it does.
like
10
10 or
years?
15 years.
I think it's 10
10
years.
years, yeah.
But I don't know that off the top of my head.